Good morning. We are going to wait just another minute to allow some people to join, and then we will go ahead and get started. All right. Good morning, and thank you for joining us for our second quarter 2024 NGL market update. My name is Rob Wilson. I'm the Vice President of Analytics and lead our NGL team, along with Christina Ajaman. And our topic this morning is ethane supply and demand and how ethane export projects and associated contractual commitments are throwing a wrench into ethane markets. We will break down our view of the components of supply and demand and talk through the logic behind each of the variables. As you know, we cover fundamental supply and demand for natural gas, crude oil, and natural gas liquids, and what those fundamental market forces mean for the outlook of midstream companies, both public and private. For NGLs, we have exciting news ahead. This year, we have already launched our free weekly newsletter, the NGL Insider, our quarterly NGL market updates. This is our second year-to-date webinar, and now the ethane supply and demand report and data set, which we created based on client demand. We will follow this up with propane supply and demand, both the report and data sets in June, and we'll likely focus on the propane markets and LPG export markets for our next webinar. The NGL forecast by purity product and the NGL network model are also undergoing improvements. For example, we are breaking out Mont Belvieu into more distinct markets in the NGL hub model. Just makes sense to do that, so that is what the direction we are heading there. Finally, for tailored solutions, we have an advisory team that helps provide custom analysis specific to a project, such as a strategic review, asset transactions, both sale and purchase, operational risk reviews ahead of security issues, and market studies. And this is across commodities and companies. If you've ever worked an advisory project with us, you probably know very well Nigel Gorbold and Ryan Smith, who head up that business. One note, this is a 30-minute presentation that could easily take an hour or more. So should you have questions about what we present, or if there's something we can help you with, do not hesitate to reach out to me. My contact information, along with Christina's, is at the tail end of this deck. So we are very accessible. Feel free to reach out to us if there's something we can clarify or help you out with based on what you hear today. So let's dive into NGLs, and we will start with a high-level view of production and then dig in to ethane from there. And like I said, production, U.S. ethane growth lives and dies on Permian and Marcellus growth. Ethane domestic demand growth is driven by higher utilization, and this is from domestic ethylene petrochemical steam crackers. And in the future, in 2026, we're talking about the new CP Chem Cutter steam cracker in Orange County, Texas. We'll cover ethane international demand, which is the most interesting piece of this exercise, where we've seen movement the most, and that's from negotiated contracts at Neches River and Marcus Hook from Enterprise Products and Energy Transfer, respectively. And then we'll talk about price volatility and risk to the upside. First, production, and we'll talk about production overall. This is our view of U.S. lower 48 crude oil production, dry gas production, and NGL production. I just like to start high level to set the table. And one thing you'll notice, this is from now through, or from 23 to 26 is really what we're focusing on. If you look at the vertical lines on each of the production charts, the crude oil outlook and NGL outlook grows a little bit faster than our dry gas production. I think that's partly because of where gas prices sit today and how that's impacted producers in the Northeast and Haynesville specifically that have curtailed production. So makes sense that most of the growth is occurring in liquids-focused basins. The Permian Basin, Marcellus, and the Haynesville are really the primary drivers. We're seeing most of the growth, of course, from the Permian, especially on the NGL side. With respect to the Permian, constraint on one commodity is a constraint on all. It's very important, the timing of Matterhorn. We have that starting line fill, I believe, in June and ramping up to full service by September. That has constrained producers' ability to grow crude production and NGL production. So you can see the dip in production from Winter Storm Heather in January, and then it flattens out, and that's from pipeline takeaway constraints, especially going east, in combination, which we'll talk about a little bit more later, with maintenance on several of Kinder Morgan's egress pipelines, one heading north and two heading east. One thing to note here too is the NGL production forecast is a little bit flatter, and part of that is because our ethane growth is flatter. When you alleviate constraints, Waha gas prices improve, the frac spread narrows, and you're not as inclined as a midstream operator to extract as much ethane at the processing plant. So you do see a little bit flatter growth, and we'll go into that a little bit more. So the dip actually for ethane, and now we're looking at ethane specifically, not NGLs, but specific to ethane. The dip there in December actually preceded Winter Storm Heather. Ethane prices dipped, narrowing the frac spread, and processors had already reacted to that narrowed frac spread before the winter storm. The bump in ethane supply that you see in March, April, and May is really in response to extremely tight takeaway markets, and like I'd mentioned, combination with El Paso natural gas pipeline, the North Main Line, and then the two pipelines, Permian Highway and Gulf Coast Express heading east, really tightens that market and incentivizes processors to recover as much ethane as possible to make room for gas egress and overall production growth out of the Permian. Finally, we do expect ethane recoveries and growth to simmer down as Matterhorn line fill comes online July, August, September, and that's why you see the dip there. So growth led by the Permian and Marcellus. We had just talked about this. A constrained market means less growth from 23 to 24. We have 43,000 barrels of growth led by the Permian, and to a smaller extent, the Northeast. We have some declines in other basins based on the aforementioned weak gas prices, which has pulled rigs off of gassy parts of the Anadarko and certainly the Haynesville. But longer term, we have almost 300,000 barrels of growth, again, led by the Permian and the Northeast. The Northeast growth is really constrained by demand at Marcus Hook, which for now is constrained. Demand into Canada on Mariner West and Utopia that feeds Ineos, and to some degree Imperial Oil. So that market is really, and then higher utilization on the Shell cracker. But that growth is really limited by demand in that market regionally. So month over month forecast evolution, and this is a new report, so we're really this is the first comparison we have. Winter weather, good for gas price, bad for ethane. It's good for gas because supply dips well below capacity, which actually strengthens Waha. When the gas price is good relative to Bellevue, you're more inclined to reject ethane into the gas stream. Not all, but at the margin. And with ethane, it's really a double whammy. So as overall gas and oil production goes down, or I should say that the other way, oil and gas production goes down 5% and 3% respectively, ethane goes down by over 9%, one, from lower overall production, and two, from more ethane rejected into the gas stream. So that's why we have the downward adjustment in our forecast month over month. And we'll be updating our forecast on a monthly basis. So you'll see when we change the forecast, we'll be very clear in how that changes. We did boost ethane recovery in March, April, May. Our gas team does a really good job, headed up by Jack Wexel and Alex Scafford, of tracking maintenance on pipelines. You can see the magnitude and timing of the maintenance on Kinder Morgan's pipes, El Paso Natural Gas, Gulf Coast Express, and PHP. Most of that maintenance is done, which should help alleviate. You've seen what Waha basis has done in in response to maintenance during an already tight market, has gone as low as almost $5 back. Or negative, $5 back of Henry Hub. So it's had a pretty severe impact. So overall, ethane supply growth from 23 to 26, 283,000 barrels a day. Permian 245, Marcellus 92, all other basins negative 54. The question is, how does that 283 or almost 300 a day of ethane supply growth compare to the demand outlook? So now that we've talked about ethane supply, let's talk about domestic demand growth. And really that's driven by two things. One is higher utilization or increased utilization rates on existing facilities. So you can see our estimated 23 utilization of the 34 or 35 steam crackers in the US is 83%. If you bump that to 87% by 25, that gets you a combined 88,000 barrels a day of demand growth just from higher utilization. When you layer on the CP cutter cracker, ethylene steam cracker, what that amounts to is a capacity to consume almost 120,000 barrels a day of ethane. Now, this facility, we do not know the specific start date. They said 2026. So in our model, we assume it starts July 1st, 2026, and runs at 50% capacity for a year, and then is at full capacity by July 1st, 2027, and we run it at 80% utilization thereafter. So when you see the plus 41 of ethane demand, just note that we've haircutted that by 50% for half a year for 2026, but certainly we're going to get more like 80% of that 118 on a run rate basis. And what that amounts to in aggregate is 129,000 barrels a day of domestic demand. Where do we line up versus the benchmark, which is EIA? Well, we're a little bit bearish. We account for some of the past seasonality. As you can see, our forecast or outlook is in the green line, and then the EIA domestic demand is in the teal line. We also have accounted for, and I had mentioned this earlier, but the CP Chem cutter steam cracker, we do not run that full utilization at full capacity day one. It's really at full capacity July 2027 is what we modeled. So when you compare us to the EIA, the net result is we are about 25,000 barrels a day bearish versus the EIA on average for 2025. So when you compare overall supply to domestic demand, the U.S. produces plenty of ethane to meet domestic demand. 283 compared to 129. I mean, we're hitting an oversupplied market, and you've got to pull some ethane off the market. Most likely via ethane rejection. That's the easiest way to do it. Just reject into the gas stream as long as there's no gas egress constraints. However, and this is the thing that has, I would say, somewhat surprised the market over the last couple of months, is more line of sight or more visibility into international demand growth, was fueled by negotiated contracts at Neches River and Marcus Hook. So let's spend some time hashing that out. And I think one thing to set a little bit of context, because this is a little bit less discussed corner of the market than oil and gas is. Ethane exports is relatively new, and I'll go over this in a minute, the timeline of kind of how this has occurred. But international markets do want cheap feedstock for the building block of manufacturing plastics. That's ethylene. And so the marginal barrel of ethane is being exported. Most of US exports are going into Europe or China or India. Those are the prime, in Mexico to some degree, those are the primary landing spots. This is not new when you compare it relative to other fossil fuels. I'd mentioned, things that are more widely discussed, right? Crude and natural gas. Crude oil has been exported for decades, but not really in scale. When you look at ethane exports, over the last 10 years or so, compound annual growth rate of 50%. Crude oil exports up a compound annual growth rate of 36%, and LNG up 188%. So this is definitely a theme, not specific to ethane, where we're still growing significantly in the US. It's definitely moderated, especially in the Permian, but we still have significant growth, and we have to grow significantly to meet booming international demand, or I'll say at least steady growth in international demand. So page 2 of context, I'm a very visual person, and so laying out kind of the timeline of how this has all happened. The first ethylene steam cracker in the US was built in the late 1950s, as far as I can tell anyway, based on the research I've done. And all the ethane produced domestically went to feed domestic ethylene steam crackers for a long time. In fact, we had plenty of ethane, and a lot of the older processing plants were refrigerant, not the new cryo that it can extract 90, 95, even a greater percent of ethane from the gas stream. A lot of the old refrigeration plants extracted a significantly smaller portion of ethane, and we had plenty to meet domestic demand. But in late 2013, Energy Transfer via Mariner West was the first to export ethane internationally, and this went directly into Canada as a feedstock for the Nova petrochemical steam cracker and Imperial Oil to a lesser degree as well. That was quickly followed up by what is Vantage Pipeline, which is now owned by Pembina, which exported ethane from PADD 2 or the Bakken into Alberta. Again, that was followed up with Energy Transfer loading ethane for the first time onto a ship and exporting it into Norway at Ineos and Sweden at Borealis. This was a significant step because prior to early 2016, we had exported ethane via pipeline, but not ship. Enterprise also entered the ethane export on vessel about 6 months after Energy Transfer did, and their export facility at Morgan's Point near Houston was backstopped by Reliance Energy in India and Ineos out of Norway as well. Kinder Morgan built the Utopia pipeline, and it's now 50-50 JV with Riverstone, which also exports ethane into Nova and Imperial Oil as end users of that ethane from the Marcellus and Utica region. And then in 1Q 2021, Energy Transfer built the Orbit facility, which is backstopped by Satellite Petrochemical in China. So Enterprise also ships ethane to China, but this was certainly a big move for Energy Transfer in getting a contract with a Chinese counterparty to backstop their Orbit facility in the U.S. Gulf Coast. And what's further impacting the ethane markets is in H2 25 or first half 26, Energy Transfer is building Neches River in 2 phases. Phase 1 is second half of 25. phase 2 is first half 26, and it's a facility that can export both ethane and propane. It can export up to 360,000 barrels a day of ethane, or up to, I believe it's 180,000 barrels of LPG, LPG exports. Energy Transfer has also discussed an expansion project at their Marcus Hook facility near Philadelphia, which is currently constrained by ethane storage and refrigeration capacity. But they are actively working a project that they've said previously will be online by the middle of 2025. So not much in the way of updates there. That's from an older earnings call transcript, but they're both actively looking to grow ethane exports. This is just some detail based on facility owner, counterparties, and then growth we have modeled in for Neches River and Marcus Hook, which amounts to 230,000 barrels a day, and most of that coming from the U.S. Gulf Coast. So let's talk about that a little bit. Total ethane exports, you can see it by pad 1, 2, and 3, and most of the growth is happening in pad 3, the light green shaded area of the chart in the upper left. What really caught the market by surprise, based on conversations I've had, is a comment that Jim Teague, CEO of Enterprise Products, made on their April 3rd Investor Day. He said, we have 450,000 barrels a day of contracted ethane exports. And this is a big deal because known exports at their Morgan's Point facility is, based on a prior disclosure, 180,000 barrels a day. Maybe it's a little more, maybe it's a little less, but the last public disclosure I've seen of contractual commitments out of Morgan's Point is 180,000 barrels a day. What this means is Enterprise Products will very likely need to use the Neches River export facility exclusively for ethane, because if you take the 450 minus 180, that gives you 270 of incremental ethane export barrels that does not currently exist at Morgan's Point. I previously mentioned the capacity there is 360 a day. What is not known is the timing of those ethane contractual commits. That I just don't know we don't know the ramp of that. So it may happen over 1, 2, 3, 4 years. We don't really know. Enterprise could use the facility as a flex ethane LPG export facility until they have enough contractual commitments. But another thing Teague said on that same call was they have line of sight into, I think he said 550,000 barrels a day. So don't be surprised if they announce an additional expansion at Neches River to handle exports above and beyond what we even currently have modeled in. What I've shown here is known ethylene steam cracker expansions or new builds. Most of these are new builds, and they're not all going to consume U.S. ethane supply growth, right? The likely ones are the INEOS facilities in China, and then Project One in Antwerp, Belgium, which will consume or have the capacity to consume a combined 150,000 barrels a day of ethane. Those are the usual suspects, I'll say. One I'm really not sure of is Bina refinery in India. I'm not sure. I'd mentioned earlier that Enterprise Products has a contract with Reliance. That's the only known Indian counterparty that U.S. ethane exporters have contracts with. So that's a little bit of a wild card. And then I assume most of Dow Chemicals ethane demand comes from Canada, and then Qatar and Saudi Arabia, their ethane demand likely comes from Saudi Arabia. Don't know, just listing all the facilities that will demand more ethane from the globe in the next, call it 5 to 6 years. So supply of 283,000 barrels a day, sufficient to meet domestic demand, not sufficient in meeting international demand. And what this means from a storage and price perspective is, the math just tells you there's a shortfall in storage, which will draw down ethane storage and put upward pressure on the price of ethane relative to the forward curve. So let's talk about that. We've hit on U.S. ethane production. We've hit on domestic demand and our assumptions around that. And we've hit on international demand and how we've modeled that in from now to 2026. So this is what this shows you is our forecast of ethane storage, and then the forward curve for Mont Belvieu C2, and then the frac spread. And generally, the frac spread, where we've seen a lot of fluctuation in ethane production, is out of the Permian. So the frac spread you see here, which is just Mont Belvieu C2 minus Waha on an equivalent basis, it's got to be generally 10 cents or above to increase the marginal production of ethane out of the Permian. However, if you take a look at the drawdown in ethane, and that's really from the ethylene steam crackers coming online in 2026, you will need, or there will be a upside volatility on price to draw more ethane production out of U.S. basins to meet that demand. So one thing we are taking a look at is our Waha outlook into 2026. And I'll talk about this in a minute. But what we see today from a math perspective is domestic demand growth of almost 130,000 barrels a day, plus international demand growth of 231,000 barrels a day, gets you total demand of 360,000 barrels a day relative to the 283. That's the 70,000 barrels a day plus shortfall. Where we could be wrong and what we are monitoring is a few things. One is the potential for understating Permian NGL growth. And this is something we'll track in the purity product forecast and ethane supply and demand. All of the new plants are highly efficient at extracting ethane that are being built. A lot of those are being built by Enterprise, Targa. Energy Transfer has some plant expansions where they're adding capacity to existing facilities. Those are the big ones. There are other facilities, Matador, EOG. We have a full list of those if you'd like to see it. But all of these new plants are incredibly efficient. So there's potential for upside in NGL growth, and that's something we're watching closely. The other is overstated declines in the other bucket, and I've broken those declines out separately by basin so you can see them. One in particular that sticks out to me is DJ down 9. I know it's not a whole lot, but if we get short ethane, these are areas where you could get more, and that's due to overall production declines in the DJ from soft gas prices. I call that one out specifically though because Chevron, a big producer in the DJ, has guided towards flat production, so we may be a little bit low there. In the Eagle Ford, you have most producers focusing on gassy basins or gassy parts of the Eagle Ford, less liquid rich like EOG, so that makes sense. The Barnett requires significantly higher gas prices to actually stay flat or grow, so that makes sense. The Anadarko is a little bit of a wild card too. That's something we'll watch very closely. And then project delays punting ethane demand. So the big project delays are, the ethylene crackers overseas that are likely contracting with Enterprise and Energy Transfer at their export facilities at Marcus Hook and Neches River. So to the extent any of those projects are delayed, you kind of, kick the can on the issue of being short ethane supply. And then the CP Chem Cutter steam cracker, there's, we've used a July 1st, 2027 start date, but many of these crackers have come online on a delayed time frame. So we have no reason to think it will be. We're just looking at history. Many of them do come online late. Again, that kicks the can on the need for additional ethane supply growth. And then finally, and this is, definitely we are in a world where you cannot just look at one commodity, especially ethane, because of the interdependencies. What we are seeing, and our gas team would be happy to talk through this, Matterhorn coming online to solve Permian egress is huge. It's extremely bottlenecked. Any sort of maintenance is very disruptive and basically just puts Waha into the dirt. Matterhorn coming online will solve natural gas egress for a shorter time frame than the market is pricing in, we believe. The Waha forward curve is not that discounted, but we see the market as being very tight end of 26. We are about to come out with our own price outlook on Waha, but the projects that have been mentioned, Warrior is an energy transfer gas egress project. Apex is one from Targa. Moss Lake was discussing or started FERC proceedings on rich gas line that goes all the way into Louisiana. What we don't know is when those projects would come online, but if they're post end of 26, we're likely to see a very tight market. And what that means for ethane is that can allow for lower prices, because as gas goes down, ethane stays flat, the frac spread widens. We'll see the same thing we're seeing now with ethane recoveries going through the roof, just to create space to get out of the Permian Basin. So this is something we're watching very closely. It's not an ethane issue, but it is an ethane issue. And so these are the types of things that we are working closely with the gas team here at East Daily to better understand how that impacts ethane. And that concludes our presentation today on ethane market fundamentals. If you have questions or interest in the ethane supply and demand data set and report, accessible from our Energy Data Studio, do not hesitate to reach out. Alternatively, the QR code on the screen will take you to more information about our new ethane product. I would like to thank everyone for joining us this morning. We really appreciate your time, and have a great rest of the day.